Today, my guest is Vinney Chopra. He's a successful multifamily syndicator. He's raised over $70 million and done over 26 successful multifamily syndications. And he's a returning guest to CREPN Radio for another dive into multifamily real estate investing. And today we're going to, it'll be a continuation of our multifamily syndication series. Today we're going to take a look at the money inside the deal for the general partner and limited partners. But first, a quick reminder, if you like the show, please let us know. You can like, share, subscribe, or leave a comment. We'd love to hear from you. And also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel, Commercial Real Estate Pro Network. Vinney, welcome back to CREPN Radio.
Thank you, Darren. It's a pleasure. I look forward to coming with you, and tremendous knowledge and so much good content you're spreading to your audience. And that's wonderful. Congratulations.
Well, I appreciate that. And you've certainly been a big part of it here. Last couple of months, we've taken a few, I think 4 or 5 now, different episodes where listeners, we've covered different topics about multifamily, syndication, building your team, attracting capital, how to underwrite the deal, and then most recently, letter of intent and purchase and sale agreement. And I want to remind the listeners, if they'd like to check any of those out, in the show notes, you can find each one of those episodes. But before we jump into our today's episode, just in case there's somebody that hasn't heard one of our previous episodes, could you give the listeners just a quick little bit about your background?
Oh, sure, Darren. I came from India many years back, 40 years back, with $7 in my pocket, and I'm a mechanical engineer. I came for my business administration degree, got into marketing and sales, and sold Bible books and encyclopedias outside Atlanta and in Virginia and South Carolina. And then I became a promotional consultant, fundraising consultant for a very reputable company, and retired from there. And then I became a broker in 2004. We lived near San Francisco. I've been married 38 years, and we've been living here 38 years, have 2 very wonderful children. And I became broker. We were wondering, what should we do with that? Should we start a brokerage house or something? And I got exposed to multifamily syndication world. That's 14 years back. And I've never looked back ever since. We used to purchase lots of single family homes, and now we sold them all in 2017. We don't have a single one. Oh, we have a duplex still. I'm sorry. One duplex.
One duplex left, huh?
One duplex left, and we got a cash flow of, I think, $1,800 a month. $1,800 on that one. So that's a pretty good one. And then, we got into syndication world and started from zero investor, Darren, and now we have 130 investors, very wonderful people, accredited investors, and very few sophisticated investors. And we have done 26 syndications. The 27th one, which we are doing right now and raised about $8-9 million now, is the $50 million fund, which is a Regulation D. We always do SEC ruling compliance and everything, Regulation D, with 506B, as in boy. We did 26 of them, and out of 26, the 27th one is 506C, as in Charlie. That's the one where we can have only accredited investors. We can advertise and everything. But in the previous ones, in 506B, one can have up to 35 sophisticated investors. And we only used to have 3 to 5 sophisticated in those deals also. And we have sold several out of the 26. We have closed on the one, 14 we did with the previous company, my company and my partner. We have only 2 left. And one is going to be closing on this Friday. So only 3 will be left. 3 were left. So 2 will be left after Friday. And then in my new company, Monil Investment Group, we had 12 syndications. We have sold 2 already. and two are under contract right now, like I was just mentioning to you, in the NASA area of Houston and Freeport. So that's kind of put you right close to where I am now.
Yeah, no, I would say that's a lot of acquisition and disposition in 14 years.
Yeah,
That's a lot more activity than your single family and your duplex.
that's right.
Uh,
That's
yeah,
for sure.
yeah,
Few extra zeros, I say,
yeah. No, lots of extra zeros. And actually, that's a great kind of a transition into what we wanted to talk about today. And I think what we've covered up to this point has been more about the property, finding the market, analyzing the deal, getting your team in place, all of the things that you need.
Mhm.
And obviously, we even talked about raising capital and talking to investors and stuff. But I think the one thing that we didn't really touch on as much as I'd like, and I think today we can accomplish this, is talk a little bit about the opportunity for the general partner and how the numbers work.
For
Uh, and,
sure,
and,
for
and make,
sure, Darren. I know it's a very awesome job, to really work with the investors and get their money putting into the deals, the offerings, we call it, and also brokers. A lot of work we have to do to cultivate relationships with the brokers. And many times syndicators feel, oh my gosh, what's in it for us? We are working so hard. And not only that, once we get on the loan, when I say most of the time, maybe the new investors may not be able to get on the loan, but you have to try to find, of course, do the financial statement so that you know the net worth of your net worth, and then get partnership with somebody in your family who has high net worth so that they can be like silent, just a signatory. We call it as a loan sponsor. The term we call, as I know Mr. Gene Trowbridge shared with me, loan enhancer or loan sponsor. So they could be the ones who will guarantee and sign along with with you, with the investor syndicator. The key thing is total uh, net worth has to be higher than the loan amount. That's what the lenders look for. That's what Fannie Mae looks for, Freddie Mac, and the institutional, banks and all. They will like to see that the loan amount will be lower than the total net worth. And nobody can be, as a limited partner side of the investors, they cannot own more than 19% of the deal. Because if somebody is 20 or above, they have to be on the loan. So that's the other part.
okay, gotcha. So just to back up just a second, make sure everybody understands on the general partner side, you have to have somebody that has a net worth that's greater than the loan, correct? So if
Correct.
you're buying a $10 million deal and you've got a loan for 7.5 or 8,
Sure. Sure.
whoever's signing for that loan has to have a net worth of at least 7.5 or 8
For sure.
plus, correct?
Totally. Totally.
Okay. And then as far as the limited partner raise, uh, typically that's designed to equal that down payment and whatever capital is needed for capex, et cetera. Is that the way that's typically?
Totally. The down payment, like you just said in this example, 25%. So 75% will be the loan amount. Or we'd like to go for 80/20 also. I know it's a tight
Sure.
market, but if we can do it, that's great. So that will be the down payment. Of course, the closing costs, all the due diligence fees, the third party reports, the loan applications, the points of the getting the loan, and then the big part is also the syndicator's acquisition fee, to put the deal together, the sweat equity, we call it, that the loan sponsor and the sponsor like us, syndicator, will be sharing an acquisition fee equal to 2% to 4% in this market. So it's not really good to only get 1% because you are working so hard, and that's what I teach my students also. You got to be really, you're bringing value to the investors, and to the other people who will be associating with the with the apartment purchase. So you want to make sure 2 to 4%. I've been getting 4% acquisition fee all this time, Now I've gone to maybe 3.5, like that. But that's just one part of the income that comes in at closing. So when we do get the loan and we put our name on the line, we have to sometimes guarantee the loans. Fannie Mae, Freddie Mac, of course, they are non-recourse loans. Those are the best loans. But many times you have to go with the local bank where the property is, or institutional financing and so forth. They like to have you guarantee the loan. The other thing I wanted to mention was the liquidity part of it. So the lenders not only look for the loan amount to be lower than your net worth, but they also like to see that we have cash in mutual funds or cash savings and liquid money, we call it, equal to about 6 to 8 months of the mortgage. So they have to make sure if something goes south in this investment, do you have money to pay the mortgage for 6 months or 8 months, like that,
Right. They don't want the keys to the apartment.
Yeah, exactly.
Right. Right.
Exactly.
Yeah.
Now you mentioned about CapEx there, and you're very right about that, because seeing the total money raised, of course, the down payment would be, then the closing cost, the third party things, the acquisition fee, 1 year of insurance money premium, we need to raise that also, because the lender loan, when they're going to be approving, they're going to ask the insurance agent, whoever you choose, to pay a whole year of premium. We have done it in the past where you could finance that. So they will write down that you have paid it in full if you have a good relationship with the insurance broker.
Sure, you transferred that over to the finance company for the
Yes,
premium, but
correct.
the premium has been paid for the year.
Correct.
Right,
Correct.
right,
And then also you have to have certain extra money for the property proration taxes.
right,
And of course, if you have saved that already, or the seller pays up to that day, but then you have to pay the rest. And then the CapEx. Let's talk about CapEx. That's a huge amount, because the older the property, the more deferred maintenance is at the property. If it's 65 built or 70 built, we'll have a lot more dollars to be spent as compared to the 80s and the 90s. So that's something we need to do ourselves, a lot of work in asking this listing broker, could you give us the CapEx, like a worksheet for the last 5 years? What has this owner or the seller put into it? How many ACs have been replaced? How long are the roofs been replaced? How many appliances? What percentage of appliances were replaced? How is the parking lot, which we can see ourselves?
right.
Foundation. So those things are quite important, And then we put that money also, we raise that money, and then of course we figure out the COC, cash on cash, is what really one should go after, not the cap rate. Cap rates will swing within the area,
Right.
but it's the cash on cash, especially if it's a momentum play, I call it. That's with 90% or more occupancy, 90 to 94% or something like that. But then that's a momentum play. As soon as you close on the property, you have a cash flow day one.
Right. Let's talk just real quick on those two things. All of the closing costs, down payment, capex, all that. Is there a general number that you would use if you were just kind of doing some back of the napkin kind of
Yep. Yep.
figures?
Yep. I
What would
would
you
say
expect?
if you're purchasing $10 million asset,
Mhm.
I'll say 30 to 35%.
Okay.
30 to 35% would be that total amount, unless the property needs a lot of money for for renovations and all that. Then it
Right.
might be towards that 35 to even 40 I've had, in my case, because then the budget goes higher and then at the time of closing, you get that much money in the checking account. We call it as the capex account, and
Right.
that's where we draw the money back, to renovate the properties and all.
Got it. So in this example, just for, again, like kind of back of the napkin kind of numbers here, if we're buying a $10 million property, you'd
Sure.
expect to raise 3 to 3.5 million
You
in
got
your
it.
capital raise.
Yep. Yep.
And would you then expect to still get a 75% uh, loan to
Yes.
purchase, or would
Yeah,
you expect
kind of. Right
80%?
about there. You're right.
Okay.
Because that is kind of, many times we go for 80/20,
Sure.
but
If you
then
can
when
get,
the
yeah, if you get
condition
the 80, that
report comes, yeah, condition report, when the lender does it, inspectors do it, then sometimes they drop it down. And it's kind of at the 11th hour. I've seen my friends get caught up. They didn't raise that 5%. And then now it's closing time and a $8 million loan at 5% is 400,000 they have to raise right away, things like
right, right. So, and just kind of following our example here of a $10 million property, just to make the numbers easy. So we estimate 3.5 capital raise. From that, that'll cover the 25% for the down payment, the closing cost. It'll fund your Capex, any taxes, insurance, um, and then that will pay the acquisition fee also to the general
correct,
partner.
correct.
Correct?
Yep,
Okay.
yep.
So, at this point, we've raised the money. We've closed on the property, and as a general partner, we've got a reward for the hard work of getting the deal to the closing line. So as we go forward now, what are the additional monies that and before I ask the question, that three, or you said 2 to 4% on the acquisition fee, is that based on the money raised or the purchase price?
That's the purchase price.
So
Actually, acquisition
two,
fee is on the purchase price of the property.
okay,
Yeah,
okay. And then as we go forward now we've got the property, we've got the contractors doing whatever capex repositioning, rent's being paid. What kind of additional uh, fees can the general partner expect to receive?
sure. Darren, in my deals, what we have done is preferred rate for the investors. So the Class A members, we call them, the LLCs formed, which is going to buy the property, and the LLC is a pass-through entity. So the investors come in, all the legal paperwork is all done. Oh, that was the other fee forgot to mention, the syndication and the real estate attorney's fees. Those are also included. His syndications might be from 10 to 15,000, right about there. And then the real estate attorney on the lender side, I've seen as high as $10,000. It's amazing how much they charge. And then your own personal real estate attorney will charge another 2 to 3,000 to do all the paperwork. So legal, it's good to have 15,000, or
Right.
16,000 accounted for. But
But
let's talk about
that's still accounted for in that 30
in
to
it is. Oh
35%.
yeah,
Yeah.
totally.
Okay.
I don't think I've ever raised 35. I would say 30 to 33 is usually the number, and
Okay.
more so towards 30. See, the reason is we need to really be tight, especially in a tight market right now, to get a better COC, cash on cash. You got to be able to find the property that does not need too much renovations. Because
Right.
if you have to do a lot of renovations and value add, you might be going into a bridge loan or mezzanine loan, and that interest rate is going to go up, points will go up, the cash on cash won't work. But
Right.
in the regular situations, yes, now I used to do, and I've done many, many deals, 60-40 split, where our investors get like 7% or 8 or 9% in good market, right, as a preferred rate, but plus they also get the cash flow in the split of 60 goes to the investors, or 65 goes to investors, or 70 goes to investors, and the balance, which is like 40 or 35 or 30 comes to the syndicator.
Gotcha.
Now,
Yeah.
you could do different ways. You could do different ways. I like it simple ways. One is where you give the investors up to the preferred rate, and then you get paid after that, higher percentage. Or you could do it splitting right there in the middle, and you say, okay, we're going to give 70% to the investors. Preferred rate is this much. And if the property doesn't give the preferred rate or higher to give you your share, you defer yours in the future, it's called. So you could defer your payout in the future. There are two kinds of trends I hear from my students and also from other investors. Some don't like to take any cash flow while the property is being managed, but then they put a threshold that the investors can only make up to 20% or 18%. And after that, they make, 50-50 or 70s the syndicator making and only 30 going back to the investors. I have done it very simply, 60-40 in the cash flow, 60-40 at the back end, or 65-35 with the cash flow during the operation of 5 to 7 years. And then when we sell it, we split it also 65-35,
Okay.
and
And just to be clear on and this is the operational
side of it.
distributions, right? So,
Right.
and you do yours quarterly, if I remember
I do.
correctly.
I do.
Okay.
I don't believe in monthly because monthly it's a lot of headaches and a lot of
Right.
checks and all that. And it's so small amounts. I love to give them larger checks. And my investors gave 4 times to the mailbox that way,
Right. Right.
rather than 12 times.
But just to be clear, so the rents come in, all the operating expenses get out, the money's left over beyond whatever your reserves are in the budgets, and that's what's dispersed. And an instance like we're talking, if it's if we're saying it's a $10 million property, let's just say, and what do you think's a realistic cap rate in today's market? Would we say 6?
I
Or,
would say 6 will be reasonable. Yes. Yeah.
okay, so if we
5.75 to 6. Yeah. Mm-hmm.
0.06, that's a 600,000 net.
NOI
So 600,000 net operating income.
income.
Divide that by 4. So you look at your quarterly net
No,
operating.
that's NOI though, minus then the
Where do you
mortgage
get
and
your
the
mortgage too? Yeah, yeah,
capex.
yeah, yeah. Yep.
Yeah.
I got to put that. So, what do you figure for the mortgage? Half
I
of
would
whatever your
say,
NOI?
yeah, about half at least. I'm thinking like, interest rate now has crept up. I mean,
Yeah.
I've been buying like 4.12, 4.14. Now it's 5%. So if we take 80, the loan of 8 million at 5, that's 400,000, just straight line, you know.
Right.
So that's going to be that mortgage interest. And
Yeah.
it's good to get interest only for 1 or 2 years starting out, because then the principal has to be paid out too,
Sure.
Yeah.
Sure. So just to kind of follow through the example here and recognizing that everything's in flux, I mean, interest rates and all
Sure.
that, but if you did have a quarterly distribution of 75,000 to your
Yes.
investors who contributed 3 million, right?
Okay.
And would you say that in your case, the first you were saying like 7 to 9% to guarantee that they received a 7 to 9% preferred return, that they made sure they got that first, and then the general partner participates on the balance? Is that what I understand?
Exactly.
Okay.
Right. What we look at is actually each quarterly basis.
Okay.
That's what we have done. Let's see, if I'm giving 8% preferred to my investors, then we give them 2% first quarter, 2% second quarter, 2% third quarter. So at the end of each quarter, we look at the total profit and loss statement for
Okay.
3 months, and we see how much cash flow did we, disposable income, we call it, after paying the mortgage and capex and all. That's the net income of 1 month, second month, third month. Combine the 3, and if it's more than the 2% that we have to give to the investors, we look at our share of 65-35. Then we get paid also every quarter.
Gotcha.
But
And
if one quarter we could not make it, then our share gets deferred. Yes.
okay, gotcha. And just to make sure that I understand and everybody else
Mhm.
does as well,
Sure.
the preferred is the first part that the limited partners get. So if you had just you said like 2% on a quarterly basis, so
Mhm. Mhm.
uh, and that's of the what they invested, correct?
Correct.
So okay,
Correct. Yep.
so they would get that, but that is 2% of the. So let's just do this real quick.
Their
So
investment.
yeah, if we
Let's say
said,
they,
let's just say there was a 10% return in a quarter.
sure.
Uh,
Sure.
so 2% is the preferred, and then the balance is split. Uh,
Well, 10% is pretty high, to be truthful. I would
okay,
say per quarter, like maybe for
okay,
the year, yes. So we do like two, 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 two. But then the fourth quarter, we do all the tallies and look at the whole year performance.
okay, I
Like,
got
for
you.
example, I gave out in one of my property 4.54, I think, in the fourth quarter. So total return to the investors, even though the preferred rate was 8, they made 10.54% that year.
I got you.
So
So you
it's
helped me.
profitable. Yeah.
So if I understand right, so rather than getting all caught up quarter to quarter, what you're doing
Yeah.
is you're guaranteeing them a percent, whatever that is, throughout the year, and
Hmm.
then at the end there's essentially a bonus based on performance.
Exactly.
Got it. Okay.
Totally. And then, we split it right there too. So in other words, I never put a limit. I've never done it in the last 12 years, never put a limit to what my investors can make, IRR, no ceiling on the top. And that's why I've been able to deliver 18 to 43% sometime per year, my investors have made, and they love it. So there's no ceiling. That's one thing I like. And then when we sell the property, right, Darren, so
Right.
we are giving these returns. And as we manage ourselves too, by the way, so when we are bringing our own values and value adds and increasing the rents, the property gets better and better and so forth. And also the rents go higher. Of course, inflation is there, job market, all that. So that's when we sell it in 5 years, we look at the equity gain, and then we give them also 65% of the equity gain, or 70, whatever, we have
Yeah,
looked in
whatever the
our
percentage
underwriting.
has been established throughout
Yeah,
from the beginning, it
exactly.
holds through, right?
Totally,
Okay.
totally, totally.
Okay. Um, And so, in just to make sure I don't miss something here. So, on the quarterly distribution, you're giving them a set preferred
Correct. For
year
three
end.
quarters.
Yeah.
For
So
three
at
quarters.
the year end, if it was a 10% for the year,
Yep. Yep.
they would in total get the whatever they're
4% in the fourth quarter, right?
right,
Yeah.
right.
Yep.
Okay.
Perfect.
And you would split whatever the difference was if you had guaranteed them a preferred rate of 8% for the year,
Sure.
and you made 10,
Yeah.
they would get the 8 that they were promised,
And we'll
uh,
only get two.
too.
And the rest will be then in the ratio, deferred, we call it, right, to the next year and so on. Yeah.
Okay. And just one more question on that. So if the split is 60-40,
Hmm.
right? 60 to the investor, 40 to the sponsor.
Sponsor. Yep.
And in a year's time, you've guaranteed them, or you've given them a preferred rate of 8, and for the year you made 10. Okay, so in that situation, if I understand right, they would get their 8,
Hmm.
correct, as a
Hmm.
preferred. There'd
Yep.
be 2 left over. Does that mean the two goes to you as the?
Okay. Yeah. This is how in the private placement memorandum, you have to disclose everything to the investors.
Mhm.
I have kind of built my whole company and business on 60-40 or 65-35 split, because you got to be making money while you are managing these assets for 5 years.
Right.
And that's why there is that split, the ratio. So we look at the whole cash flow, and even right in the starting, when we give it out to the underwriters and ourselves, we look at it, and the 5 to 7 year projections, we have already shown those numbers, that the total cash flow 65 giving to the investors is going to get them 8, 8, 8, 9, 10, whatever, and
Right.
35% is going to be given to the sponsors and the syndicators like us, right?
Okay.
Yeah.
And I guess in just to make sure that, or to wrap that up, it's
Sure.
the year end. the investors gets whatever their preferred is first, right?
Yes,
And then whatever the balance is what you would
exactly.
be left with. Okay, I got
Totally, totally.
you. Okay,
And
thanks
then,
for
there
walking
are
through that.
other fees. I know you were saying like, oh no, go ahead.
No, I just wanted to ask you. So now because we jumped ahead to disposition fee, and I
Yeah.
get that one. I wanted to ask you about refinancing because that seems to be in a property that appreciates rapidly based on the ability to reposition the property and revalue the property. Seems to be a real viable strategy to recapitalize the investors. Can you talk about that?
Oh, totally, totally. As the value gets added and you see the cap rate has shrunk, gone down, the value has gone up, and the NOI has gone up, that's a perfect time for us to refinance and take the money out. Now, in the PPM papers, Dean Trowbridge and Kim Taylor, our attorneys, have really taught me well. We need to give 100% of that money back to the investors. We cannot keep any money out of that refinance unless we can give all the money back up to their investment. It's called return of capital. If there is any money left behind, then we can do the split again, because by refinancing we are bringing the LTV higher, loan to value higher. So the risk is there on the part of investors and us too, because we are on a bigger loan now,
Sure.
and more mortgage will be given out and so forth. We have done it 4 times, I think, so far in our syndications. And one of them, we just sold that property, by the way, after 6 years. I'm so happy. We gave out 40% IRR, 40% to our investors for 6 years in a row.
40% IRR annual.
Annual.
Yeah.
So if they put in 100,000, Darren, they got, like, at the equity gain, including the cash flow, 40,000, 40,000, 40,000, 40,000 for 6 years. So 100,000 brought them 240,000 more. I mean, that was our
Oh,
just
that's a
a
home run, huh?
stellar home
Yeah,
run.
that's great.
The good part I wanted to share with you was we returned all their investors' money at refinance 3 years back, or 3.5 years back. So we were still giving them cash flows infinity percentage
Oh, wow.
because they had zero money into it, but we will still give them cash flow in the ratios. So they were enjoying that. Now we sold the property, so we got an equity gain also to give them back. So it's
Oh,
a good thing. We usually charge about 1% refinance fee because it takes a lot of efforts on the part of syndicator to get the things ready, to get it all approved, to sort out who is going to give us the refinancing best deal and things like that. So 1%. Disposition fee usually is 1 to 2% also. That's when you're selling the asset. You have to prepare the asset. You have to do a lot of property tours, reports. You have to select the right, get the BPOs, broker price opinion, from 4 different brokers in that market, and then you meet with them. So a lot of work is involved. So that's another fee we charge. Asset management fee is another one, which is very common, by the way.
and
That is
what
the
do you
asset
normally do for
manager.
that?
Yeah,
Yeah.
we usually 1%, 1 to 2%. In my case, I've not been charging any because we also manage the asset. So I wanted to share that. That's the fourth way we get paid, is if you have your own management company like mine, Monil Management Group. We manage and we get monthly paid for managing the managers, we call it. That's what it is. If we were to give that asset to a third party outside, they're going to charge us 3 to 4%, not 5, 3 to 4%. And it goes higher if the property is smaller number of units, like if it's 50 units, 60, 70 units, the property management company might charge 5 to 6 percent, 7% even,
Sure.
because the revenue is not that high and they have a lot of work to do. Same thing in our company, Monil Management Group. We manage all our acquisitions. So we do get paid 4% of the total rent and total income collected per apartment. So every first of the month, sorry, we get paid, 4%.
Right, but even in that, the fee would have been earned by an outside manager. If you
Exactly.
had, so so while that's benefit to you based on your structure, it's not like it's
No, it's not
it's
detrimental.
earned. It's
No, not
earned.
at
Yeah,
all. Yeah.
yeah,
And
it's
the investors love it, Darren. It's
yeah,
amazing. They love the fact that we are keeping an eye and that we are responsible of their money, which is added, put into the asset. And that way we are negotiating. I just did, like, I calculated $8 million renovations in just last 2 years. I did it at our assets, 12 of them. And the good part is I negotiated so much. I mean, you become better and better and better. I think I've saved my investors and our company at least 2 million. I mean, I can literally say that. So I saved $2 million because of better negotiations, buying very nicely. Now I'm buying everything from Amazon. Can you believe it? For multifamily.
yeah. No, it's crazy. The
It's crazy.
Amazon now kind of it
Oh.
just is absolutely. I mean, the Amazon effect is real.
It
It
is
is
real. It
absolutely yeah,
really is. I
yeah,
mean, my, maintenance people don't have to travel to the stores. Product is delivered right there.
yeah.
No shipping, prime. For $99, 125, I think. I ship out tons and tons and tons of all the property setups up there and everything. So, what other fee I might have missed? I do want to say that I don't charge asset management fee because I'm managing the asset also,
Right,
from my company, but I do put it in. And thanks to Kim Taylor, she says, Vinny, if the investors remove you for any reason, you do want to put in the PPM and operating agreement 1 to 2% asset management fee will be charged by the third party, because see, nobody's going to really come in and watch the asset for the investors
right,
unless they
right.
have some money, some stake in it. So that's why we say that asset management fee of 1 to 2% will be there if Vinny's removed. At this time, Vinny does not charge any asset management fee. And I'm a broker also in California, so we disclose that Vinny doesn't take any commission splits or anything, which I don't. I give it to the listing agent.
No, no, I think that that's really kind of not that it was a mystery before. I mean, I think we've gone a long ways to talking about this at different times, but not
Sure.
necessarily all encapsulated in just one conversation,
Right.
kind of thing. And so from just my notes here, these are the fees or the opportunities for the general partner
Hmm.
to earn in the deal. We've got the acquisition fee. Um, we mentioned loan guarantor
Sponsor,
or sponsor fee.
guarantor.
So
Sure.
if the syndicator is that, I presume that's theirs to make, or would that, should we talk a little bit about bringing somebody in? Or I guess we did kind of talk about finding somebody.
Yeah,
Uh,
I
to,
would love to share that. See, the investors come on the LP side, which is the limited partner side, and
right,
the general partner side is the other one. So if it's 65% is with the investors, their money, and they are getting 65 or 70% even in this tough market, then 30% is the one, the GP side.
right,
Now, from the 30% of the acquisition fee of the quarterly cash flows, I call it, and the equity gain, which will be at the end. So those are the three ways we get paid, right?
right,
Acquisition, during the process, we are managing the asset, and
right.
then when we dispose it off,
Dispose, right,
those three fees, right? And then, of course, managed service fee, which we get it because we are managing the asset, property management, we call it fee,
right,
right?
right,
Um, Now, if there is a partner who is signing on the loan, we call it as the loan enhancer or loan sponsor. And usually you have to give them 10 to 15% of the GP side,
okay,
yeah. So, 10 to 15 to even 20% of that 30%, if I may say, right? Because you are really in, day out. You're working hard to earn that money and making sure that the investors are well taken care of, holding the meetings, webinars, all that, making sure all the, public relations and investor relations, we call it also. But at the same token, the reporting and making sure that the numbers are jiving to the projections that we did. So that's an awesome, awesome job that syndicators have to do. And that's why we get paid for that.
No, I think it's, the opportunities are tremendous. I mean, there's always been
Sure.
the understanding of just you're dealing with much larger properties, and
Sure.
when you multiply the numbers, there's money.
Yeah.
But just to actually look into and exactly see where the money, how the syndicator, how the deal sponsor
Yes.
gets paid, was kind of the goal of this conversation. I think you've done an excellent job
Thank you.
pointing that out. And before, just to kind of wrap up here, I was going to ask you, um, have you ever, has it ever made sense to you to buy or to refinance and to buy your uh, limited partners out?
You know,
There's a property you wanted to keep or something like that, and the other, because the sunset of your investment agreement said you'd sell in 5 to 7 years, and you saw more runway. Has that ever been anything you've looked at?
At this time we have not, but I do know that's a very viable option, by the way, because many times I know when I started 12 years back, a lot of investors saying, how long do I have to tie the money with
Right.
you? And that was a negative. They were saying, would I get my money back sooner? So
Right.
that's when we started saying 3 to 5 years. Then we went to 3 to 7 years. So it depends. Different things, education money, retirement, travel money, things like that. So we have not done that much where we have bought out. We do have in the operating agreement first right of refusal, we call it, if somebody wants to sell their share and we are keeping the property. But you're right. I think with the market where it is now, I'm more considering now some properties which are making 30, 40,000 a month net. Why to sell them? I mean, it's just very good cash cow, I call it. But if
Yeah.
some
No.
investors want to move, take the money out for whatever reason, we have the first right to buy, and I will be buying them. Yeah.
I gotcha.
Yep.
Gotcha.
Yep.
Well, Vinny, you've done a great job helping myself and the listeners understand, the numbers inside the deal, inside the syndication for the general partner, and truly appreciate that. Um, if there's one thing you'd like the listeners to take from today's podcast, could you
I
share
would
that?
love to. I would say that this is like the hot market, I call it, top of the cycle market. It's a seller's market, not a buyer's market, but deals do come through. A lot of students ask me, who are my investors, very established, and they say, Winnie, should we be out of the market? And I always say, stay in the market to get the best deals. If the market corrects, have the money ready with the investors. Now is the time to double down and just talk to the investors a lot more. The stock market has had a very big bull, as we all know, 10 years or so, and something is going to correct. But
Yeah.
if we are buying in the right emerging markets, we should look into and be underwriting and be talking to the brokers, and not only one or two brokers, but in one particular market have relationships with 5 to 7 brokers, because different trees have different fruits, and
Right.
everybody has different comfort level, and they will know their own brokers, and they're not going to list with just one broker. So really make those time to build those relationships and investors. That's why I started the fund, $50 million fund, because I'm selling some deals. My investors are saying where to park the money now, where to invest, and we haven't bought anything. We have underwritten so many good things, but haven't really come with that good solid property investment. So my
Yeah.
thinking is that don't give up, keep in the game, and then just encourage each other with your team partners, perfect the systems, but raise more money, raise. That is the key, because as the opportunity comes with the correction coming up, you should be ready to have the money come into the deal and close them out, quicker.
That's great. Vinney, where can the listeners go if they'd like to learn more and connect with you?
Oh, sure, Darren. I've built the academy as in the background. My team puts that on there with my green screen. Monil Academy, which is the multifamily academy. We are doing really, really big. I've got 623 video clips now that I'm
Uh-huh.
teaching different segments. And Youth Academy, which is amazing. Again, it's free. Multifamily Academy is very nominal price, but then they could just text the word syndication, SYNDICATION, to 474747. So if you just text the word syndication to 474747, my team members or I will get back to you. And then we have some freebies and updates and all that, so that we could provide. VinneyChopra.com is my other website, VINNEY CHOPRA, Chopra.com. I'm in YouTube, Instagram, Twitter. I'm a very reachable person. So, if I can help a lot of people, it will be my privilege. And we provide all our templates, all PowerPoints, everything in my academy, where people can really start from day one right away.
Got it. And I'll list that in the show notes and
Thank you.
make sure listeners find that.
Thank
Vinney,
you.
I want to say thanks again for taking the time today. I've enjoyed it and learned a lot, and look forward to doing it again soon.
I will. I'll look forward to it, Darren. You're a wonderful person, and what a great value you're bringing to your audience. And I want to just applaud you. That's
All right.
wonderful. It's good to be a friend of yours. And, please invite, just let me know, and let's take some more deeper topics and bring more knowledge out to everybody,
You got it. We
Thank
will
you.
be in touch.
Sure.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.